Hello, everyone, and welcome to our discussion of managerial accounting. As you probably noticed in Chapter 4, this is a very small portion of Chapter 4. Despite the relatively short page coverage given to this topic, you want to tuck this knowledge away. All right, you really want to think about these topics because they are fundamental to a course that you may take called Accounting for Planning and Control. Okay, Accounting for Planning and Control is a required course for all students in the MBA program. And so if you're in the MBA program, you will be required to take that course. At the heart of that course is contribution margin and break-even quantity. Okay, so please watch this section very carefully. And even for those that never take accounting for planning control, if you go into any kind of entrepreneurial activity, managerial accounting is actually going to drive your short-term operating processes even more so than financial accounting. So first, what do we mean by managerial accounting? Managerial accounting is that type of accounting that's very operations driven, that's geared more towards company insiders, meaning individuals that work for the company. You get access to data, insights from what's going on with customers and product lines and pricing that outsiders will never see on the annual income statement or annual balance sheet. In particular, managerial accounting allows managers to do the following. Number one, properly allocate costs to different product lines. And a fundamental example of allocating costs is the allocation of overhead. And when you think overhead, think of things like broad expenses that the company incurs that aren't directly tied to a certain line of business activity. Think of a company that a car dealership that has maybe the sales side of used cars, sales side of new cars, but then also has auto detail, the detail arm that handles the cleaning of cars and maybe a repair side of the firm as well. Well, the janitorial crew that comes in and gets the contract to keep that facility looking great each and every day, there's a fixed charge for that the dealership covers overall. But the question then would be, well, how do we allocate that cost for the janitorial service across these different areas of the company? And that's important, right? Because as we look at different areas of this car dealership, we want to assess their profitability. Well, how did the new car sales side do this year? Well, how did the automotive detail side do? Well, how did the car repair and paint and body shop, how did it do? And so it's not just based on their revenues that they generate, it's also based on their revenues minus their costs. So the allocation of things like overhead is really, really important. All right, and so it's not always as easy as saying, well, you got 4 distinct units associated with the car dealership, so just divide those janitorial services by 4. Well, it may be that you want to allocate based on square footage of the facility, right? Or it may be that you use more of what is called activity-based costing, where you allocate overhead costs based on the sales or revenue activity of the area. So there are other options here. And our point is not to get too tied into the weeds on different options. That's for future courses. But we do want to be aware of this issue. Cost control is important. We know that from our analysis of the income statement. A second key thing the managerial accounting does for us is it allows us to track divisional operating performance against a budget. And lets us do what is called variance analysis, where we have projected revenues, projected costs, projected measures of profit. And once we have those projections, we can then go forward in time and see how our actual performance stacks up against those projections. And so we can have either a favorable or unfavorable variance depending on what the relationship is like between the projected value and the realized value. So really getting to the key concepts in this small section of Chapter 4, the first key concept you really have to wrap your head around is, can I delineate between variable and fixed cost? It's very, very important to note that. And noting the distinction is important. You may say, well, both are costs, so as long as I'm subtracting the amount of revenue to get to profit, surely I've got my bases covered. Yes and no. for a purely profitability measure, that may be the case, that just accounting for them both together is fine. But as we assess the ongoing viability or sustainability of the business enterprise, we want to denote the difference between variable and fixed costs. The key benefit of variable costs is that we can get rid of them very easily, right? If we start a product line that's new and it turns out to not, customer demand for it is way softer than we thought, then we can just stop operating in that product line and those variable costs go away, right? That's because variable costs vary with operating activity. So think of things like direct materials and direct labor. If we start making a certain kind of widget that requires a certain kind of product and certain kind of labor intensive time, if no one wants to buy those widgets, then after the first quarter or first year, we just shut down that line of widget making, and all those direct materials and direct labor costs go away, right? That's the beauty of variable cost. It's easy to reverse our decision. Fixed cost, not quite the same, not even by a long shot. Fixed costs are invariant to operating activity, meaning that no matter how high our sales levels are, our production needs are, fixed costs are the same. Fixed costs are the same. If I lease a building and I have to pay $25,000 a month, and I've got a 2-year lease on that building, I've got a $25,000 a month expenditure that's a fixed cost for the next 24 months, regardless of whether I sell 50 units, 1,000 units, or 25,000 units. So I got to deal with it, which means higher levels of fixed costs in general give more risk to the company, more risk to the enterprise. Does that mean fixed costs are bad? No, but they are incurred regardless of the revenue we generate. Number 2, calculate the contribution margin. Calculate the contribution margin. The definition of the contribution margin is very important. That's revenues minus variable cost. Revenues minus variable cost. So the contribution margin gets its name from the fact that any revenues above and beyond variable cost can be used or contribute to the defraying or paying down a fixed cost. Make sense? Contribute, i.e. contribution margin. Yeah. So really what we're doing here is matching those variable costs that are positively correlated, right, with revenues. We want to net those out immediately and say, okay, whatever's left over, that goes towards covering fixed cost. That could be on an aggregate basis, meaning on a total product line or for a total company for a year, or we just subtract on the income statement revenues minus cost of goods sold. Or more likely, we would look at it on a per unit sold basis. That's what you're going to do more of in accounting for planning and control, on a per unit sold basis. And the beauty of that is that it gets us to number 3, and that is that we're allowed then to calculate the sales quantity that allows for break even. If we know our contribution margin and we know our fixed costs, we can then answer the question of, okay, how many units must I sell so that I now cover all my variable costs and so that I now cover all of my fixed costs? And that just gets me to break even from an operating perspective. Now, we're not happy, we're not satisfied with just operating break even, right? Because we also have non-operating costs to cover, such as interest and taxes, but still, it's a nice starting point. So the 2 contribution margin examples that show up in the book, we're going to get to those in a minute with a graph, but if you want to think about this first one that shows up in the book with an aggregate example. When I say aggregate here, I'm referring to an entire income statement for an entire firm or for an entire area of the company or product line of the company. So if the company has revenues of $100 million and cost of goods sold are $40 million, just take the difference, revenues minus cost of goods sold, and you're left with your contribution margin, $60 million, meaning that $60 million could contribute to defraying fixed cost. Now, we know from our income statement analysis, we could also call that gross profit. On a per unit example, this is the more common application in my mind of contribution margin, where we look at things on a per unit basis. So suppose that for just a simplified example, that my company only sells one type of product. We sell a certain kind of product and just that only that one type. And we sell each of those for $200 a unit. Each one though costs us variable cost of $120, meaning direct material and direct labor together sum up to be equal to 120. And so that gets us to a contribution margin of $80, meaning that for each unit we sell, we earn $80 in contribution margin. So basically $120 of each $200 sold is out the door immediately. The higher the contribution margin, I think it goes without saying, but let's make it explicit, right? The higher the contribution margin, the more profitable the enterprise is likely to be, and just the lower the level of firm risk. Which takes us to break-even analysis. And again, the critical question in managerial accounting on this is how many units must be sold to break even? This is particularly of interest when we're looking at new business ventures, right? If I'm worried about, all right, I'm thinking about trying out this new thing, I don't know how it's going to work. I'm really worried about breaking even, both for me as an entrepreneur or for my shareholders and creditors that are investing in my company. Break-even analysis for our purposes is very easily answered using the following equation, right? Assuming we know what our fixed costs are, or like the entire year, if we know our contribution margin per unit, we simply divide fixed costs by our contribution margin per unit. And that's going to tell me the number of units I must sell to break even. Now, the example we'll look at from the book is the numbers are fictional, right? So it comes out to be a nice, easy number to deal with. Real world, it's more likely to be a value that has to be rounded up. Remember, this is break-even quantity, units sold, so you're not going to look at selling half a widget or 0.2 units of a widget. Just round it up or down depending on how the math works out for you there. So here's an example of that. From earlier, suppose we know that contribution margin per unit is $120. So suppose we went through this analysis using a different example, okay? And we also know that our total fixed costs are $12 million. Okay, so using the equation below, which is the same one from the previous slide, we can take that $12 million and divide it by a $120 contribution margin per unit. And that's going to tell me the number of units sold. So on the right-hand side of the slide, we've just created some exhibits here that show you exactly what appears in the book. What they're saying with that top line is that you're basically solving the algebra problem of, okay, I'm going to earn $120 per unit in contribution margin. I'm going to multiply that by X units, saying that I don't know how much X must be, so that 120 times X gets me to 12 million. That is, my total contribution margin equals my fixed cost. So not just the individual per unit contribution margin, but the total contribution margin earned. So think about that on an aggregate basis. So we know that we can plug straight in the equation though and just do $12 million divided by $120 contribution margin. That's going to give me a value of 100,000 units, meaning that I need to sell 100,000 units just to break even. And so we can take that information and then make some insights from it and think about, okay, well, how likely is it that I will sell 100,000 units? Is that totally outside the realm of possibilities? If I can include that, then that's great information to have, right? Because at that point I could say, well, I only forecasted at best 50,000 units sold. So this would definitely be not a good use of money, right? That's why this topic is so fundamental and so important. Not just to large companies looking at new product lines or new goods sold, but also to small entrepreneurs as well. The other into things, if I believe my most likely number of units sold is 105,000, and we might say, well, we're above 100 is below the 105 that we expect to sell, so maybe we should give it a shot here. This is a graphical analysis of break even, and so this graph shows up in your book, and it's a really good graph to be aware of. It gives us some good insights, and so you could sketch one of these pretty easily by hand as well. So let's talk about the axes first, as we should with any graph. The vertical axis, the y-axis, if you will, is in dollars, and that's measuring your profit. Okay, anything above zero is going to be profit. Anything below zero is going to be loss. On the x-axis, the horizontal line, you've got units sold. Okay, so always think about your intercept points. All right, so if we think about that y-intercept, that intercept on the profit line, notice where it hits the curve at negative 12 million. Why is it negative 12 million there? Because that's telling me that at 0 units sold, I incur my fixed cost of $12 million, meaning my profit is actually negative $12 million. I sold zero, which means there are no variable costs. There's no sales either, but I still have to incur those fixed cost of $12 million. That's the nature of fixed costs. They occur regardless of sales or production activity. But notice what happens as I sell more and more units. As I do that, that line starts to come out from the from negative 12 million and starts to slope upwards. And notice it's a straight slope here, positive slope. It's a linearly sloped line. And what that slope is showing me is that I'm earning $120 for every additional unit sold, which is my contribution margin. So basically the slope of the line is capturing your contribution margin. And then notice where we hit the x-intercept, where we intersect the unit sold line. That occurs at 100,000 units. And what is the x-intercept telling me here? That's telling me where my profit is zero. Now, do I want a profit of zero? No, but that's an important point to know because that's where break even occurs. Because I have a break-even profit of zero. So once I sell one more unit than $100,000, 100,000 units, excuse me, that's when my profit starts to creep above zero. And hence the line segment above 100,000 units is showing you how now you're earning a profit. Yeah, if you sell this many units right here, whatever this number is, suppose that's 105,000, then now your profit is going to be right here. And so as we sell more and more units, profit goes up. So the difference between the horizontal axis right here and this line segment going up here is giving them my profit reading all the way throughout. Overall, managerial accounting, very helpful tool. Break-even analysis in particular, using the contribution margin, fundamental to assessing product line risk, product risk, or service risk.